Section 3.1 to 5.2 Understanding the Dollar Index. Section 3, Factors Affecting the Dollar Index. 3.1 Macroeconomic Factors. Macroeconomic factors play a significant role in influencing the dollar index, reflecting the overall strength or weakness of the US dollar. Let's examine the impact of key macroeconomic factors on the dollar index. Interest rates. Interest rate differentials can have a substantial impact on the dollar index. Higher interest rates in the United States relative to other countries can attract foreign investors seeking higher returns. This increased demand for U.S. assets, such as bonds and equities, can strengthen the U.S. dollar and potentially drive up the dollar index. Conversely, lower interest rates or diverging monetary policies may weaken the U.S. dollar and contribute to a lower index value. Inflation. Inflation levels affect the purchasing power of a currency. When inflation is low or stable in the United States compared to other countries, the US dollar may be perceived as relatively stronger, potentially increasing the dollar index value. Conversely, higher inflation rates or concerns about inflation eroding the value of the US dollar can weaken the currency and lead to a lower index value. GDP growth. Economic growth is an essential determinant of currency strength. Higher GDP growth in the United States, relative to other countries, can attract foreign investment and bolster the US dollar, potentially increasing the dollar index. On the other hand, slower economic growth or economic underperformance may weaken the US dollar and contribute to a lower index value. Fiscal policies. Fiscal policies, including government spending, taxation, and budget deficits, can impact the dollar index. Expansionary fiscal policies, such as increased government spending or tax cuts, can stimulate economic growth and potentially strengthen the US dollar, contributing to a higher index value. Conversely, contractionary fiscal policies or concerns about unsustainable fiscal deficits may weaken the US dollar and lead to a lower index value. It's important to note that the impact of these macroeconomic factors on the dollar index is complex and can be influenced by various factors and market dynamics. Additionally, the dollar index is also influenced by factors specific to other currencies included in the index, as well as global market sentiment, geopolitical developments, and other economic indicators. Market participants, including currency traders, investors, and central banks, closely monitor these macroeconomic factors and their potential impact on the dollar index to assess the relative strength or weakness of the US dollar and make informed decisions in currency markets. Several key economic indicators influence the value of the U.S. dollar. These indicators provide insights into the overall health of the U.S. economy and its relative performance compared to other economies. Here are some of the key economic indicators that have a significant impact on the U.S. dollar. Gross domestic product, GDP. GDP measures the total value of goods and services produced within a country. Strong GDP growth indicates a healthy and robust economy, attracting foreign investment and potentially strengthening the US dollar. Positive GDP surprises can lead to a higher US dollar, while weaker than expected GDP growth may weaken the currency. Interest rates. The level of interest rates set by the US Federal Reserve has a significant impact on the value of the US dollar. Higher interest rates can attract foreign capital seeking higher returns, increasing demand for the US dollar and potentially strengthening it. Conversely, lower interest rates can reduce the attractiveness of the currency and lead to a weaker US dollar. Inflation. Inflation measures the rate at which prices for goods and services rise. Low or stable inflation is generally positive for the value of a currency. A low inflation environment can maintain the purchasing power of the US dollar and make it more attractive to investors. Higher inflation rates, on the other hand, can erode the value of the currency and potentially weaken it. Employment indicators. Employment indicators, such as the non-farm payrolls report and the unemployment rate, provide insights into the health of the labor market. Positive employment data, indicating robust job creation and low unemployment, can boost confidence in the U.S. economy and strengthen the U.S. dollar. Conversely, weak employment data may raise concerns about economic growth and weaken the currency. Trade balance. The trade balance measures the difference between a country's exports and imports. A positive trade balance, where exports exceed imports, can strengthen the US dollar as it reflects the relative competitiveness of US goods and services. Conversely, a negative trade balance can put downward pressure on the U.S. dollar. Consumer confidence. Consumer confidence surveys provide insights into the sentiment and spending intentions of consumers. High levels of consumer confidence indicate optimism and potential strength in the economy, supporting the U.S. dollar. Conversely, low consumer confidence can raise concerns about economic growth and weaken the currency. Central bank policy, actions and statements by the U.S. Federal Reserve, as well as other central banks, can significantly influence the value of the U.S. dollar. Changes in monetary policy, including interest rate decisions, quantitative easing measures, or forward guidance, can have a direct impact on the currency's value. These indicators are closely monitored by market participants, including currency traders, investors, and central banks, as they provide insights into the health of the U.S. economy and the potential direction of the U.S. dollar in currency markets. It's important to note that these indicators do not act in isolation, and their impact on the U.S. dollar is influenced by various factors and market dynamics. 3.2 Geopolitical and market factors. Geopolitical events, global market trends, and investor sentiment can have a significant influence on the dollar index. Here's how these factors impact the index. Geopolitical events. Major geopolitical events can create volatility and uncertainty in global markets, leading to fluctuations in the dollar index. For example, geopolitical tensions, political instability, trade disputes, or geopolitical conflicts can impact investor sentiment and increase demand for safe haven assets, including the U.S. dollar. In such cases, the dollar index may rise as investors seek the relative safety and liquidity of the U.S. dollar. Conversely, resolutions of geopolitical tensions or positive developments in international relations can reduce uncertainty and potentially weaken the U.S. dollar. Global market trends. Global market trends, including movements in equity markets, commodities, and bond markets, can influence the dollar index. Risk-on or risk-off sentiments can impact investor preferences and demand for different currencies, including the U.S. dollar. During periods of risk aversion, investors tend to move away from riskier assets and seek safe haven assets like the U.S. dollar, potentially leading to a higher dollar index. Conversely, during risk-on periods, when investors are more willing to take on risk, the demand for safe haven currencies may decline, potentially weakening the U.S. dollar and lowering the dollar index. Investor sentiment. Investor sentiment plays a crucial role in currency markets and can influence the dollar index. Positive or negative investor sentiment towards the U.S. economy, monetary policy, or political stability can impact the attractiveness of the U.S. dollar. Positive sentiment. Reflecting confidence in the U.S. economy or favorable market conditions, can strengthen the U.S. dollar and potentially increase the dollar index. Conversely, negative sentiment, driven by concerns about economic performance, policy uncertainties, or market disruptions, can weaken the U.S. dollar and lower the dollar index. Market expectations and sentiment towards central bank policies. Investor expectations and sentiment towards the monetary policies of central banks, including the U.S. Federal Reserve, can impact the dollar index. Changes in interest rate expectations, monetary policy decisions, or forward guidance from central banks can influence investor sentiment towards the U.S. dollar. If market participants anticipate more hawkish or tightening measures from the Federal Reserve, it can strengthen the U.S. dollar and potentially increase the dollar index. Conversely, if expectations shift towards a more dovish or accommodative stance, it can weaken the U.S. dollar and lower the index. It's important to note that these factors are dynamic and can interact with each other, leading to complex and sometimes unpredictable movements in the dollar index. Currency markets are influenced by a wide range of factors, and market participants closely monitor geopolitical events, global market trends, and investor sentiment to assess the potential impact on the value of the U.S. dollar and make informed trading decisions. Factors such as political stability, trade policies, and risk appetite can have a significant impact on the dollar index. Let's examine how each of these factors can influence the index. Political stability. Political stability is an important consideration for investors and can impact the value of the U.S. dollar. A stable political environment is generally perceived as positive for economic growth and investment. It can attract foreign investors and increase confidence in the U.S. economy, potentially strengthening the U.S. dollar and leading to a higher dollar index. On the other hand, political instability, such as elections, political crises, or policy uncertainties, can create volatility and weaken the US dollar, potentially resulting in a lower index value. Trade policies, including tariffs, trade agreements, and protectionist measures, can impact the value of the US dollar and the dollar index. Changes in trade policies can affect the competitiveness of US exports and imports, as well as trade relations with other countries. Positive developments, such as the signing of favorable trade agreements or the reduction of trade barriers, can enhance investor confidence and potentially strengthen the US dollar, leading to a higher index value. Conversely, trade tensions, tariffs, or protectionist measures can weigh on market sentiment and weaken the US dollar, potentially resulting in a lower index value. Risk appetite, or investors' willingness to take on risk, can influence the dollar index. During periods of high risk aversion, investors tend to seek safe haven assets, including the US dollar, as a store of value. This increased demand for the US dollar can strengthen the currency and potentially drive up the dollar index. Conversely, when risk appetite increases, investors may shift away from safe haven assets and towards higher yielding or riskier assets, potentially weakening the US dollar and leading to a lower index value. Economic and financial market stability. The stability of the US economy and financial markets can impact the dollar index. Positive economic data, such as strong GDP growth, low unemployment, and stable inflation, can attract investors to the US dollar and potentially strengthen it, contributing to a higher index value. Similarly, financial market stability, including the health of the banking sector and the performance of equity markets, can influence investor sentiment towards the US dollar. Positive developments in the economy and financial markets can support the US dollar, while economic or financial market instability can weaken it and lower the index value. It's important to note that these factors do not act in isolation and can interact with each other, leading to complex dynamics in the currency markets. Market participants closely monitor political developments, trade policies, and risk appetite to assess their potential impact on the value of the US dollar and make informed decisions in currency trading. Section 4, Intermarket Analysis and Trading Strategies. 4.1 Relationship with other markets. The dollar index can exhibit correlations with other asset classes, although the strength and direction of these correlations can vary over time. Here's a general overview of the relationships between the dollar index and different asset classes. Stocks. The relationship between the dollar index and stock markets is complex and can be influenced by various factors. In general, there is an inverse relationship between the US dollar and US stocks. When the US dollar weakens, it can benefit multinational companies with significant foreign operations, as their exports become more competitive and their foreign earnings are worth more when converted back into dollars. This can potentially lead to higher stock prices. Conversely, a stronger US dollar can pose challenges for multinational companies, potentially impacting their earnings and stock performance. However, it's important to note that correlations between the dollar index and stock markets can vary based on factors such as interest rates, economic conditions, and investor sentiment. Bonds. The relationship between the dollar index and bonds is also influenced by various factors. Generally, there is an inverse relationship between the US dollar and US Treasury bonds. When the US dollar weakens, it can lead to increased demand for US Treasury bonds as a safe haven asset, potentially driving down bond yields. Conversely, a stronger US dollar can reduce the attractiveness of US Treasury bonds to foreign investors, potentially leading to higher bond yields. However, correlations can be affected by factors such as interest rate differentials, inflation expectations, and market sentiment. Commodities. The relationship between the dollar index and commodities is often inverse. A weaker US dollar can make commodities priced in dollars, such as oil, gold, and industrial metals, relatively cheaper for international buyers, potentially increasing demand and driving up commodity prices. Conversely, a stronger US dollar can make commodities more expensive in other currencies, potentially reducing demand and leading to lower commodity prices. However, correlations between the dollar index and specific commodities can also be influenced by factors such as supply and demand dynamics, geopolitical events, and market-specific fundamentals. Precious metals, particularly gold, are often seen as a hedge against currency depreciation and inflation. Therefore, the relationship between the dollar index and precious metals is typically inverse. A weaker US dollar can increase the appeal of gold and other precious metals as an alternative store of value, potentially driving up their prices. Conversely, a stronger US dollar can reduce the demand for precious metals, potentially leading to lower prices. However, it's worth noting that other factors, such as investor sentiment, global economic conditions, and central bank policies, can also influence the prices of precious metals. It's important to remember that correlations between the dollar index and other asset classes can vary over time and are subject to the influence of multiple factors. Additionally, correlations can differ for different time periods and market conditions. Therefore, it is crucial to conduct thorough analysis and consider other market factors when examining the relationships between the dollar index and various asset classes. Intermarket analysis is a trading approach that involves studying the relationships between different markets and asset classes to make informed trading decisions. When it comes to the dollar index, intermarket analysis can provide valuable insights into the potential impact on other markets and guide trading strategies. Here's how intermarket analysis can be applied to dollar index movements. Currency pairs. The dollar index is essentially a basket of currencies weighted against the US dollar. By analyzing the dollar index, traders can gain insights into the potential strength or weakness of the US dollar against other major currencies. This information can be used to identify potential trading opportunities in specific currency pairs. For example, if the dollar index is showing strength, traders may consider bullish positions in currency pairs where the US dollar is the base currency and bearish positions in currency pairs where the US dollar is the quote currency. Stocks. The US dollar and stock markets can exhibit an inverse relationship due to factors such as export competitiveness, corporate earnings, and investor sentiment. By analyzing the dollar index alongside stock market indices, such as the S&P 500 or Dow Jones Industrial Average, traders can identify potential correlations and divergence. For example, if the dollar index is weakening while stock markets are rising, it may indicate a risk-on environment where investors are favoring stocks over the US dollar. Conversely, if the dollar index is strengthening while stock markets are declining, it may suggest a risk-off sentiment where investors are seeking the relative safety of the US dollar. Commodities and precious metals. The dollar index and commodities, particularly those priced in US dollars, can exhibit an inverse relationship. By analyzing the dollar index alongside commodity prices, such as oil, gold, or industrial metals, traders can identify potential correlations. A weaker US dollar, as reflected in the dollar index, can lead to higher commodity prices, while a stronger US dollar can have the opposite effect. This information can be used to assess trading opportunities in commodities or to gauge potential impacts on commodity-dependent industries. Bonds and interest rates. The dollar index and bond yields can have an inverse relationship. By analyzing the dollar index alongside government bond yields, such as U.S. Treasury yields, traders can gain insights into potential correlations. A weaker U.S. dollar can lead to increased demand for U.S. Treasury bonds as a safe haven asset, potentially driving down yields. Conversely, a stronger U.S. dollar can reduce demand for U.S. Treasury bonds, potentially leading to higher yields. This information can be used to assess trading opportunities in bond markets or to gauge potential impacts on interest rate-sensitive assets. When applying intermarket analysis to the dollar index, it's important to consider that correlations can change over time, and other market factors can also influence price movements. Therefore, traders should combine intermarket analysis with other technical and fundamental analysis tools to make well-rounded trading decisions. Additionally, thorough research and careful risk management are essential for successful trading based on intermarket analysis. 4.2 Trading strategies with the dollar index. Trading strategies that utilize the dollar index can take advantage of its movements to generate trading signals and make informed trading decisions. Here are 3 common trading strategies that can be applied to the dollar index. Trend following strategy. A trend following strategy aims to identify and ride the prevailing trend in the market. Traders using this strategy would monitor the direction and strength of the trend in the dollar index and take positions that align with the trend. For example, if the dollar index is in an uptrend, indicating strength in the US dollar, traders may take long positions or buy US dollar-based currency pairs. Conversely, if the dollar index is in a downtrend, indicating weakness in the US dollar, traders may take short positions or sell US dollar-based currency pairs. Trend-following strategies often involve the use of technical indicators, such as moving averages or trend lines, to confirm and validate the trend signals. Mean reversion strategy. A mean reversion strategy assumes that price deviations from the average tend to revert back to the mean over time. Traders using this strategy would look for overextended moves in the dollar index and take positions that anticipate a reversal towards the mean. For example, if the dollar index has experienced a significant rally and is trading at or near overbought levels, traders may anticipate a potential reversal or correction and take short positions. Conversely, if the dollar index has experienced a significant decline and is trading at or near oversold levels, traders may anticipate a potential rebound and take long positions. Mean reversion strategies often involve the use of oscillators or other technical indicators to identify overbought or oversold conditions. Breakout strategy. A breakout strategy aims to capitalize on significant price movements that occur when the price breaks out of a defined range or a key level of support or resistance. Traders using this strategy would monitor the dollar index for potential breakout signals and take positions in the direction of the breakout. For example, if the dollar index has been consolidating within a narrow range and then breaks above a key resistance level, traders may take long positions expecting further upside momentum. Conversely, if the dollar index breaks below a key support level after a period of consolidation, traders may take short positions anticipating further downside momentum. Breakout strategies often involve the use of technical indicators, such as trend lines or chart patterns, to identify and validate breakout signals. It's important to note that these trading strategies are just examples and should be adapted and tested according to individual trading preferences and risk tolerance. Traders using these strategies should also consider incorporating risk management techniques, such as setting stop-loss orders and managing position sizes, to protect against potential losses. Additionally, combining multiple strategies or using them in conjunction with other analysis techniques can further enhance trading decisions. Technical analysis indicators and chart patterns can be valuable tools when analyzing the dollar index and making trading decisions. Here are some commonly used indicators and chart patterns that traders may consider when analyzing the dollar index. Moving averages. Moving averages smooth out price data and help identify trends and potential support/resistance levels. Traders often use popular moving averages like the 50-day and 200-day moving averages to identify the direction of the trend and potential levels of support or resistance in the dollar index. Relative Strength Index, RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. Traders may use the RSI to identify overbought or oversold conditions in the dollar index, which can signal potential reversal points or shifts in market sentiment. Bollinger Bands. Bollinger Bands consist of a moving average and two standard deviation bands plotted above and below the average. They help identify periods of high volatility and potential price reversals. Traders may use Bollinger Bands to assess the volatility and potential range of the dollar index. Fibonacci retracement. Fibonacci retracement levels are horizontal lines drawn on a price chart to identify potential levels of support or resistance. Traders may use Fibonacci retracement levels in conjunction with the dollar index to identify areas where price corrections or reversals are likely to occur. Chart patterns. Chart patterns, such as triangles, double tops, double bottoms, head and shoulders, and flags, can provide insights into potential future price movements. Traders may look for these patterns in the dollar index to anticipate trend continuations or reversals. Trend lines. Trend lines are diagonal lines drawn on a price chart to connect significant highs or lows. They help identify the direction of the trend and potential levels of support or resistance. Traders may use trend lines in the dollar index to confirm the trend and identify potential entry or exit points. It's important to note that no single indicator or chart pattern is foolproof, and traders should use them in combination with other analysis techniques and their own judgment. Additionally, historical price patterns may not always repeat, so it's essential to consider the current market conditions, news events, and other factors that may impact the dollar index. Lastly, risk management practices should always be employed to protect against potential losses. Section 5 Understanding the Dollar Index, Practical Applications and Risk Management. 5.1 Portfolio Allocation and Risk Management. The dollar index can serve as a useful tool for portfolio allocation and risk management in several ways. Diversification. The dollar index represents the value of the US dollar against a basket of major currencies. Including the dollar index as a component of a diversified portfolio can provide exposure to the performance of the US dollar relative to other currencies. This can help reduce concentration risk and provide a hedge against potential currency fluctuations. Hedging. The dollar index can be used as a hedging tool to manage currency risk in international portfolios. If an investor holds significant foreign assets denominated in different currencies, changes in the dollar index can affect the value of those assets when converted back to US dollars. By monitoring the dollar index and its movements, investors can adjust their currency hedging strategies accordingly to mitigate potential currency risk. Risk assessment. The dollar index can provide insights into market sentiment and economic conditions. Changes in the dollar index may reflect shifts in global economic trends, monetary policies, or geopolitical events. By analyzing the dollar index alongside other economic indicators and market data, investors can assess the overall risk environment and make informed decisions regarding their portfolio allocation and risk management strategies. Currency exposure management. For investors who have specific currency exposure needs or preferences, the dollar index can help guide decisions related to currency allocation. For example, if an investor believes the US dollar will strengthen against other major currencies, they may allocate a higher portion of their portfolio to US dollar-denominated assets or hedge their foreign currency exposure. Conversely, if an investor expects the US dollar to weaken, they may reduce their exposure to US dollar-denominated assets or consider allocating more to assets denominated in other currencies. Tactical asset allocation. The dollar index can be used as a reference point for tactical asset allocation decisions. By monitoring the dollar index and its relative strength or weakness, investors can adjust their allocation across different asset classes, such as stocks, bonds, commodities, or precious metals, based on their views on the US dollar and its potential impact on those asset classes. It's important to note that the dollar index is just one tool among many that investors can use for portfolio allocation and risk management. It should be used in conjunction with other analysis techniques, risk management strategies, and consideration of individual investment goals, time horizons, and risk tolerance. Additionally, consulting with a financial advisor or investment professional can provide personalized guidance based on specific investment objectives and circumstances. Diversification strategies and hedging techniques using the dollar index can be valuable for managing currency risk and optimizing portfolio performance. Here are some approaches to diversification and hedging using the dollar index. Diversification through currency allocation. The dollar index represents a basket of major currencies, providing exposure to the US dollar's value against those currencies. By including the dollar index in a diversified portfolio, investors gain exposure to multiple currencies and can potentially benefit from diversification effects. This approach can help reduce the concentration risk associated with holding a single currency and provide a broader currency exposure. Currency overlay strategies. Currency overlay strategies involve actively managing currency exposure within a portfolio. By monitoring the movements of the dollar index and other currency pairs, investors can adjust their currency positions to potentially mitigate risk or enhance returns. For example, if the dollar index is expected to weaken, investors may reduce their US dollar exposure or hedge their currency risk by taking positions in other currencies that are expected to strengthen. Currency hedging. The dollar index can be used as a reference for hedging currency risk in international portfolios. If an investor holds foreign assets denominated in different currencies, changes in the dollar index can impact the value of those assets when converted back to US dollars. By using currency derivatives, such as futures, options, or currency forward contracts, investors can hedge their currency exposure by taking positions that offset potential losses resulting from currency fluctuations. Tactical asset allocation. The dollar index can inform tactical asset allocation decisions by providing insights into the strength or weakness of the US dollar. Based on the outlook for the US dollar, investors can adjust their allocation across different asset classes. For example, if the dollar index is expected to strengthen, investors may consider increasing their allocation to US dollar-denominated assets or assets that have a negative correlation with the US dollar. Risk management. The dollar index can be used as a tool for risk management by monitoring market sentiment and economic conditions. Changes in the dollar index can signal shifts in global economic trends or geopolitical events that may impact portfolio performance. By incorporating the dollar index into risk management strategies, investors can adjust their portfolio allocations and risk exposure to mitigate potential downside risks. It's important to note that diversification and hedging strategies come with their own considerations and potential limitations. The effectiveness of these strategies will depend on factors such as the investor's specific objectives, risk tolerance, investment horizon, and market conditions. Additionally, the use of derivatives for hedging purposes involves additional risks and complexities that should be thoroughly understood before implementation. Consulting with a financial advisor or investment professional can provide tailored guidance and help determine the most appropriate diversification and hedging strategies based on individual circumstances. 5.2 Fundamental Analysis and Forecasting. Fundamental analysis can be used to assess the future direction of the dollar index by examining key economic factors and fundamental indicators that impact the value of the US dollar. Here are some fundamental analysis techniques that can be applied. Macroeconomic indicators. Monitoring macroeconomic indicators such as GDP growth, inflation, interest rates, employment data, and trade balances can provide insights into the strength and direction of the U.S. economy. Positive economic data, such as robust GDP growth, low inflation, and strong employment figures, may support a stronger U.S. dollar and potentially lead to a higher dollar index. Monetary policy. Analyzing the monetary policy decisions of the U.S. Federal Reserve, Fed, is crucial for assessing the future direction of the dollar index. Changes in interest rates, quantitative easing programs, and forward guidance provided by the central bank can have a significant impact on the US dollar. Traders should closely monitor statements, speeches, and policy actions by the Fed, as they can provide guidance on the future path of interest rates and influence the dollar index. Fiscal policy and government actions. Government policies, fiscal stimulus measures, tax reforms, and political developments can also influence the US dollar's value and the dollar index. Assessing the impact of fiscal policies on economic growth. Inflation and the overall business environment can help gauge the potential direction of the US dollar. Geopolitical factors. Geopolitical events, such as trade disputes, geopolitical tensions, and changes in international relations, can have a significant impact on the dollar index. Evaluating the potential consequences of geopolitical events and their implications for trade flows, investor sentiment, and global economic stability can provide insights into the future direction of the US dollar. Market sentiment and investor behavior. Understanding market sentiment and investor behavior is crucial in assessing the dollar index. Factors such as risk appetite, flight to safety flows, and investor sentiment towards the US dollar as a reserve currency can influence its value. Monitoring market trends, sentiment indicators, and positioning data can help gauge investor sentiment towards the US dollar and potential shifts in market expectations. It's important to note that fundamental analysis requires a comprehensive understanding of economic data, policies, and global events, as well as their potential impact on currency markets. Additionally, the interplay between various fundamental factors can be complex, and market reactions may not always be straightforward. Therefore, combining fundamental analysis with other analysis techniques, such as technical analysis and market sentiment analysis, can provide a more comprehensive view when assessing the future direction of the dollar index. Forecasting the future direction of the dollar index involves analyzing economic indicators, central bank policies, and geopolitical factors. Here's how these elements can be used in forecasting the dollar index. Economic indicators, such as GDP growth, inflation rates, employment data, and trade balances, provide insights into the health and performance of the U.S. economy. By analyzing these indicators, investors can assess the overall economic outlook and make predictions about the future strength or weakness of the US dollar. For example, strong economic growth. Low inflation and favorable trade balances may indicate a stronger US dollar and potentially lead to an increase in the dollar index. Central bank policies. Central banks, particularly the U.S. Federal Reserve, Fed, play a crucial role in shaping the value of the U.S. dollar. Monitoring central bank policies, such as interest rate decisions, quantitative easing programs, and forward guidance, can provide valuable insights into the future path of the U.S. dollar and the dollar index. Changes in interest rates, for example, can impact currency valuations and influence investor expectations about the U.S. dollar's strength or weakness. Geopolitical analysis. Geopolitical events and developments have a significant impact on currency markets and can influence the dollar index. Analyzing geopolitical factors, such as trade disputes, political tensions, and policy changes, helps assess the potential implications for the U.S. dollar. For instance, trade tensions between the U.S. and its trading partners can affect global trade flows and investor sentiment towards the U.S. dollar. Geopolitical analysis helps identify potential risks and opportunities that can impact the dollar index. Sentiment and market analysis. Market sentiment and investor behavior play a crucial role in determining currency movements. Analyzing market sentiment indicators, positioning data, and market trends can provide insights into investor expectations and potential shifts in sentiment towards the U.S. dollar. Understanding market dynamics and sentiment can help forecast the future direction of the dollar index. It's important to note that forecasting the dollar index is a complex task and involves uncertainties. Multiple factors can influence the index, and their interplay can be challenging to predict accurately. Additionally, unexpected events or changes in market dynamics can impact the dollar index's trajectory. Therefore, it's advisable to combine multiple analysis techniques, including technical analysis, fundamental analysis, and geopolitical analysis, to gain a more comprehensive view and improve forecasting accuracy. Additionally, staying updated with current news, economic data releases, and central bank announcements is essential for making informed forecasts.